Yeah, so good evening.
Good evening, sir.
Yeah, so thank you very much for hearing my call late in the day, in accepting my request to meet you today. So let me first send my apology, or rather for those inconvenienced through the sudden change. So once again, I will not be available this weekend. And for that reason, I requested that I meet you today so that we cover the Saturday class. Otherwise, welcome to today's class. When I begin on the next, and probably what I will have as my last topic of discussion. So remember, your exams are, I believe, are 3 weeks away, technically. Make sure that you are revising. Read through the handout which I sent before, the one with the theory. If you do not have access to it, please request somebody to resend it. That plus, of course, what we are going to discuss, that is including this topic, should be enough to help you pass. The topic on consolidation has a lot of theory. In terms of what should introduce it, that is why before class, I think a couple of hours ago, I have sent a material which you needed to have gone through briefly so that we are at par as we then proceed. When we talk of consolidation, what does this mean? And could I
Mwalimu, hautusikii?
could I hear from one or two of you what consolidation means? What is to consolidate? Anyone? In very simple words, what is to consolidate? Could we hear from anyone? Yes? Just from basic English, what does to consolidate mean?
Is to combine two
Thank you very
things
much,
together.
Phyllis.
Bringing together.
Yeah, so bringing together to combine, that is what I am looking for. So that to consolidate very simply means to combine. And in this case, we shall be combining, remember, the financial statements. And we shall be combining the financial statements of two or more companies. You may have company A, their financial statements are being combined with those of company B, so that at the end of the day, they make up 1. This is what we call consolidation. Allow me to even simplify further that what we combine are the financial statements. And so like for the two companies, you may be combining the P&L. And one of the items you can have in the P&L is normally sales. So company A may have sales of something like 10. This we can combine with the sales of company B, which may be something like 8. At the end of the day, combined as 1, we shall have 18. So that this is the principle that therefore we base the concept of consolidation, combining 2 or more companies, and what we combine are their financial reports. If it is a P&L, you can combine an item like the sales. At the end of the day, all the companies combined will appear as if you then have one company. All right. The next thing is this. When do we deem consolidation necessary? When do we consolidate? We consolidate where one company has acquired another. Let's take an example. With say company A acquiring company B. And by us saying that company A is acquired company B, what A acquired in B are the shares in B. And that has to be very clear. Company acquisitions are normal in terms of buying the issued share capital of that particular company. When I say company A is acquired company B, then what A acquires in B are then the shares in company B. It is under this condition that let's appreciate consolidation become necessary. And allow me to say this. When company A acquired shares in company B, we shall call company A an investor. We shall call company A an investor, and then we shall call company B an investee. So that by this we mean A will have invested in company B by buying the shares in company B. Such acquisition shall then necessitate that we then proceed to consolidate the two. Allow me to say this. In company A acquiring company B, A must pay company B an acquisition price. This acquisition price, we have met it before. And this is what we had called the purchase consideration. If you can remember the discussion which we had, under the conversion of partnerships into limited company, we were very clear that when you convert the partnership into a company, the new company has to pay a price to acquire the partnership business. So the same thing happens here. When company A invests in a company B, A must pay a price for the investment. This price that one company pays to buy the shares in another, is what once again we shall call the purchase consideration. And could we have a reminder of in what form does the buying company normally settle this purchase consideration? Under conversion of partnerships, we were very clear that this purchase price is settled in 3 possible forms. Could we have reminders? In what forms is the purchase consideration settled? What, and what? Very quickly. Somebody?
Cash.
Say that the settlement can be done in cash. That's okay. In what else? What form? What form also? In shares. In shares. And then lastly, this could also be settled in debentures. So the same discussion shall remain here. That when A acquires B, then A can settle the purchase price in terms of cash, in terms of shares, or in terms of debentures. All right. The next discussion becomes that of what? Become that of what are the various types of, let me call them relationships. And these things are in the notes, so you don't need to repeat writing them. Just understand, maybe as you summarize what you have, yeah? So that types of relationships between investor and the investee. Now, we normally have 3 types of celebrated relationships. And one is what we call parent and subsidiary. One is what we call the parent and subsidiary. Number two, yeah, is what we call investor. And joint venture relationship. And then 3 and last is what we call investor and associate. So these are the 3 types of relationship that you can have between company A and B. They can be a parent subsidiary, they can be an investor joint venture, they can be an investor associate. And let me make it clear as to what differentiates between these 3 types of relationships between investor and investee. In the parent and subsidiary relationship, we look at where the investor has bought more than 50% of the shares of the investee. Let me give an example. If company A has acquired company B, and A has bought something like 90% of the shares in B, then the parent and subsidiary relationship arises. So where the investor has bought, I repeat, where the investor has bought more than 50% of the shares of the investee, we shall have relationship type 1. An example here is where A has bought 90% of the shares in B. Let's appreciate it. We shall call company A the parent whereas we shall call company B the subsidiary. Why? Because the parent will be said to have over the subsidiary what we call control. When the investor has acquired more than 50% of shares, the investor gains control over the investee. So that in this respect, we shall say that A controls B, remember, to the extent of 90%. What then gives the investor control over the investee, that is any shareholding that is more than 50%. Just one more thing to add. If the parent company has bought 90% of the subsidiary, there is that proportion which remains, which the parent has not bought. In this case, this is 10%. If the parent owns 90%, the remaining proportion that the parent does not own, this is what we call the non-controlling interest. And going forward, non-controlling interest, I will abbreviate it as NCI. So every time I talk of NCI, I mean non-controlling interest. And please note, note, this is the proportion that the parent company does not own within the subsidiary now company. So that relationship, type 1. Let me go to number 2. The investee company become what we call a joint venture, where the investor has bought in it exactly 50%. So of the total shares of the investee, in this relationship, the investor owns exactly, not more, not less, exactly 50%. We then call this relationship a joint venture arrangement. So that in this case, company A has then acquired in B exactly 50%. We call company A simply the investor, and then company B, we call it venture or venture. We call it venture, or what we also call the joint now venture. It's a joint venture because the other 50% is held by another investor or other investors. So in a joint venture arrangement, what happens is this. If the venture is company B and A owns in it what we've said as 50%, the other 50% could then be owned by another company like company X. We shall call company A and X venturers. We shall call company A and X venturers, or simply investors. And then we shall call company B, of course, the joint venture. So relationship type 2 could also be called a joint arrangement or a joint venture arrangement. So that lastly, we have investor and associate. The investor and associate will occur where the investor has bought, anything less than 50%, but equal to or more than now 20%. In other words, less than 50, but then at least 20%. Let me say that An example is where company A has bought in company B, something like 30%. We shall call company A, again an investor, and then we shall call company B, then an associate. So the three types of relationships which then exist under consolidation, and the concept on consolidation shall apply, therefore, for these three. What we need to understand are therefore the thresholds that gives us the three relationships. Having understood that, the most extensive one, where we shall spend most of our time and our discussion on, is then this number one, the parent and subsidiary now relationship. So how does this relationship then work? All right. All right. Now, what therefore IFRS 3 requires is that as a parent company, you consolidate. And you know, to consolidate, we say the means combine. What IFRS 3 requires is that as a parent company, consolidate your subsidiary. What this means is simple. As a parent company, as you prepare your financial statements, make sure to include the financial reports, of course, of your subsidiary or subsidiaries. Let me give an example. If we have company A acquiring company B, and A acquires, like I said before, 90%, then A shall not prepare financial statements for it alone. Rather, A shall combine the financial statements of company B. As A, for example, prepares their P&L, then A will combine its P&L, the P&L for A, with the P&L for B. Such that at the end of the day, the two companies will appear as if they are one. And that's how consolidation operates. Now, there are rules of consolidating parents and subsidiaries. In the material which I sent, all these rules are there. But then you will allow me to do this. Let's proceed to look at the rules as we then discuss our first question on consolidation. So in this case, I'll be taking a shortcut in terms of how this will be done. Otherwise, we should first look at the what? The rules. But because the rules will be similar from one consolidation question to another, then allow we simplify this discussion by straight away proceeding to a question on this. As we go through the question, then the various rules, we will proceed to discuss them, so that later on, you can look through the rules in details, look through that material and understand the rules even better. But of course, I'll be explaining in detail as we go through the first question that we'll do. In that respect, let's look at August 2022. August 2022, we look at question number, I believe number 2, So August 2022, we look at question number 2. August 2022, we look at question number 2. August 2022, we look at question 2. So you can take a few minutes, like 2-3 minutes, to read through the question. So read through the question, yeah? Yes, I think we can then proceed. We can then proceed together. Yeah. Now, the first thing to note is in the introductory paragraph. You know where the question says that Kuja Limited has owned 70% of a company called 20 Limited's equity share capital since 1st of April, the year was 2017. So the first thing to note, and this will be as a working, is that we have the group structure. So the structure of the group is in a manner that we have a company called Kuja Limited, now which has acquired another called 20 Limited. The question says that Kuja Limited has owned 70% of the share capital of 20 Limited. That makes Kuja Limited the parent company in this arrangement, and 20 Limited is who we call the subsidiary. If the parent company owns 70%, the other proportion which remain, we call it non-controlling interest, and this is therefore 30%. So that has to be very clear. The second thing to note is that 20 Limited was bought on 1st of April 2017. That is when Kuja acquired company 20. 1st of April, we are told 2017. We have to then appreciate if 20 Limited was bought on 1st of April 2017, we are consolidating a number of years later. We are consolidating on 31st March 2022. So we must acknowledge how many years have passed since when we acquired 20 to date when we report, and how many years are these correctly counted? Somebody. How many years are these? Somebody? Yes? How many years are these? Somebody? Stella says are 6 years. Are they 6 years really? Please correctly count them. 5 years. So these are 5 years. These are 5 years correctly counted. All right. If this is the case, then we can proceed to the second thing to note. Let's go to additional information number 1. Let's go to additional info number 1 and appreciate what is there. If note number 1 says this, that a fair value exercise was carried out on 1st of April 2017. Remember, that is when we acquired company 20. For a fair value exercise carried out on 1st of April 2017, when we acquired 20. concluded that the carrying amounts of 20 limiteds net assets approximated. To approximate is to equal. So the carrying amount, and the carrying amount is a book value. So the book values of 20 limiteds net assets were equal to their fair values. In other words, when the book values were compared to fair values, the two values were found to be the same. In other words, we had no revaluation surplus, neither did we have a revaluation deficit. But let's look at what we are told thereafter. That with the exception of an item of plant and equipment, which had a carrying amount of 100 million shillings below its fair what? Fair value. So we are told for the net assets general, the book values were the same as the fair values, except for one plant and equipment whose carrying amount, whose book value was below fair value. You know, in revaluation under published financial statements, we saw that when the fair value is more, when a fair value of an asset is more than book value, we end up with what we call a revaluation what? Surplus. In this respect, if we are told that the book value was less than the fair value by 100 million, it's more or less like we are saying that the new value for the asset, upon revaluing it, exceeded the book value. When the new value on revaluation exceeds book value, then for an asset you end up with what we call a revaluation what? Surplus. Let's acknowledge that the second thing to note is that we have a revaluation surplus. We have a revaluation surplus. This is by company 20. The surplus occurred, do not forget, on acquisition of company now 20. The question says that the surplus is how much money? 100 million. The surplus is normally the excess. This is normally the excess of the fair value. Remember, over the book value, or alternatively, what we call the carrying amount. So carrying amount is simply a book value. Now, what happens is this. When the investor company acquires the investee for purposes of the acquisition, the investee may revalue assets. When assets are revalued, then you have two possibilities. That assets are increased in value, in which case we have a revaluation surplus, or assets are decreased in value, in which case we have a revaluation what? Now deficit. Our concern will be, as we then account for consolidation, how is this revaluation surplus then accounted for? This we shall account for the normal way, because when you have a surplus on asset revaluation, it means you have increased the asset in value. To then increase the asset in value, you add the surplus to the value of the asset you've had before. And this is going to mean that the surplus of 100 million you are going to add it to, add it to PPE. In other words, you add it to the asset. You know, the asset we evaluated here was the plant and equipment. So you add that to the asset, PPA, and also, we'll add this to equity. We'll add this to equity. Remember, as a revaluation what? As a revaluation reserve. Of course, again, we've already seen that when you increase an asset in value, the increase reported, add that to the asset value. Correspondingly, you treat the increase or the surplus appreciate as a revaluation what? Reserve. As we then go through the consolidation process, then for company 20, let's be very clear. We shall add the 100 million to two things, to the PPE by 20, and then secondly, to the equity by company now 20. And that's it for how you account for this revaluation what? Now surplus. The next thing to check on is this. Is this asset revalued depreciation? When this asset revalued is one you depreciate, then there will occur the problem of what we call depreciation understatement by this company revaluing. Why does the problem of depreciation understatement occur? The fact that the question talks about this revaluation surplus in the notes, it means the revaluation surplus has not been considered yet. This has not been accounted for yet. If this has not been accounted for, then what this means, when the revaluing company computed their depreciation earlier, they had not increased asset value by this 100 million. They therefore computed depreciation on an asset value which is understated by this 100 what? Million. When they therefore computed their depreciation expenditure, they understated their depreciation by what? By the depreciation in this reported surplus of 100 million. The next issue to therefore compute and deal with will be that of depreciation what? Understatement. There will be depreciation understatement by company 20. This is by the company revaluing. And let's agree, the depreciation understatement is what? Is very simply the depreciation in the reported surplus, such that if the surplus we are reporting is 100 million, we get the depreciation in it. When you look through note number 1, depreciation we are to determine based on useful life. And note number 1 is very clear that the remaining useful life of the asset is how many years? 10 years. To then get depreciation understatement by 20 per year, divide the 100 million by 10 years. By 10 years, so that if you divide by 10 years, how much understatement do we get per year? Somebody.
10,000.
Not 10,000, but 10 million.
I can't see.
10 million. So we have 10 million as the depreciation and a statement. Please appreciate per annum. Let me remind us of this. The revaluation surplus arose when? When did we experience the revaluation surplus? We experienced the revaluation surplus on the date we acquired. On the date we acquired, remember company 20. We've agreed we acquired company 20 5 years ago. If since 5 years ago, we've then understated our depreciation per year by 10 million. By 10 million, then please let's agree the total depreciation understatement to account for. The total depreciation understatement to account for will be 10 million per year multiplied by 5 years. So the total depreciation understatement to account for, we then have 50 million. Because the understatement we have computed per year, which is 10 million, let's agree, is understatement yearly. If we bought company 20 5 years back, then we account for total depreciation, therefore of 10 by 5 years. That is 50 million. Now, for purposes of accounting for it, as we then prepare our financial reports, I will again separate these 50 million into two parts. What two parts are these? I need separately the understatement for the current year. I need separately the understatement for the current year, and again separately, I need the understatement for the previous. I need the understatement for the previous years. And please let's agree, the current year is only 1 year. The current year is only 1 year. If it is only 1 year, then what we give it is 10 million. The previous years are 4 years, so that in total you have 5 years. That means what we attribute to the previous years is therefore now 40 million. For reasons of accounting for the two later, then we have to separate now that way. But of course, what you have to remember, how do we normally account for depreciation? Depreciation we normally account for in 2 ways. One, we account for it as an expenditure. One, we account for it as an expense, and so we minus from what? From profit. Secondly, we account for depreciation by minusing. We do minus it from what? Value of PPE. So let's agree, if these are the treatments we attribute to depreciation, what problem arises? Therefore, when we understate our depreciation expenditure, when we understate depreciation expenditure, we therefore to the profits, we understate it. Or rather to the profits, when you understate an expenditure, you normally overstate profits again to PPA, because we do minus depreciation for it. When we understate the depreciation, we end up overstating the PPE also. When this is the condition, then let's agree that the depreciation understatement, which is this, the 10 million total 50 broken down to 10 and 40, how do we adjust for it? And this is what you need to remember, that we shall account for this depreciation expenditure later, because you've understated profit, or rather, sorry, because you've overstated profit, again overstated PPE, then we account for the depreciation understatement by we minus the understatement from what and what? One from profit, and then number two from PPE. I will repeat. When you understate depreciation, you overstate two things. One, you overstate profit, and then number two, you overstate PPE. Because the two are overstated, to then account for the depreciation understatement, this 10, the total of 50, the broken down of 10 and 40, we account for them by minusing from profit and what? And PPE. If that's well understood, then I will proceed on to the next working. So the next thing to note will be, we will skip all the way to note number 4. I want you guys to skip note number 2 and 3. Let's go all the way to note number 4. 2 and 3, we shall look at them later. What are we told in note number 4? That during the year ended 31st March 2022, during the current year, 20 Limited sold goods worth 200 million to Kuja Limited. Allow me to explain this. When one group company sells goods to another group company, like now 20 and Kuja have done, then such a sale, we shall call it intra-group. We shall call it intra-group sale of goods. So that my working number 3 will then be about the intra-group. Intra means within. Intra means within. So we have intra-group. This is sale. This is sale, remember, of goods. The company selling, we are told, is company 20, subsidiary 20, selling goods worth 200 million. Remember, to company Kuya. When this sale occurs, how have the two companies accounted for it? In a normal sale, 20 as the seller will account for the 200 million as sales. 20 will say, we have sales of 200 million, remember, to company Kuja. Kuja, on the other hand, will say that the 200 million is a what? Is a purchase. They will say that we have purchased 200 million from who? From 20. And so reporting wise, that is what the two companies have what? Therefore reported. Now, what is the accounting reality of this transaction the moment we consolidate? Allow me to remind us of this. When I consolidate company Kuja and company 20, when I consolidate parent and subsidiary, remember, they become one. They become one thing. They become one thing. And actually, I do liken consolidation to marriage. Bible is very clear that when the man comes together with the woman, they become one thing. What this means is simple. There is technically no realistic transaction that can occur between these two people. There is no way when you are one person, then you can sell from yourself. Again, you can purchase from yourself. Upon consolidation, let's appreciate it. We shall treat this sale and this purchase as what? Fake. This yes has occurred, yeah? But because this is between companies which are in one group, who are one thing, then this sale and this purchase, we treat it as what? Fake. If this is fake, upon consolidation, we are required that we eliminate this transaction. How shall we account for or eliminate this transaction? The treatment will be very simple. That we minus 200 million from what? From the group sales. From the group sales and the group cost of what? Cost of sales. So very simply, minus the 200 million from the group sales. And again, group cost of what? Cost of sales. And so for the intergroup sales, that is what you need to remember. As we then prepare the consolidated P&L, yeah, later, then the 200 million, we shall minus from sales and from cost of what? Cost of sales. This is done because I repeat, this transaction is considered what? Fake. All right. The next thing to note, and this is about the same thing, is this. When Trader Limited sells to company Koja, and they are in one group, when Trader sells to Koja, the sale happens, remember, at a what? At a profit. Twende must report some profit on sale. All right. When this is the position, this is the next thing. Look at this. If part of what is sold remain in the stocks of company Koja, if at the end of the period, part of this which is sold remain in the stocks of company Kuja, it will mean that the closing stock of company Kuja will have in it this profit. Will have in it profit. Because the sales occur at a profit, if at the end of the period, the buying company, which in this case is company Kuja, still has part of these goods within closing stock, then the closing stock of Kuja will have profit in it. You know, this is what we said. The initial transaction is what? Is a fake. If even the initial transaction is fake, can these remaining profits in stock be realistic? Let's agree that happen. If even the initial transaction that led to the profit is a fake, then even the profit that remain in stock is also what? Is also fake. So this profit that has remained in stock, it is also what? It is also fake. When this profit is fake, then this profit has to be dealt with. It has to be accounted for. The next thing to then work out will be what we call unrealized. Will be what we call unrealized profit. This is what I will call UPS. The UPS on closing stock. On closing stock, and the entity which does not realize the profit is the one that sold the goods. So that UPS is normally by seller. By seller, the seller here, remember, is company 20. Let's agree. The UPS is there. The UPS is there for the profit in goods sold intragroup. Goods sold intragroup remaining. The profits in goods sold intragroup remaining in what? In stock. Remaining in stock. In the stocks which remained, how much profit remained in it? That profit in the stocks which remain is the profit that we say is fake. The fake profit is what I call in accounting UPS, or the unrealized profits. Let's agree. We must then, for accounting purposes, because this profit is fake, but then it's been reported by the company which sold the goods, then of course we must determine it and under consolidation eliminate it because the profit is fake. How do we compute this profit? The first thing to do is to calculate out of the goods which were sold intragroup, how much remained. The intragroup sale was a total of 200 million. When you look through note number 4, what are we told remained in stock at period end? What does the question say remain? What fraction? Note number 4.
A quarter.
A quarter, which is how much? A quarter, which we are told is 25%. When you look at the last statement, note number 4, it's very clear that Kuja Limited, the buying company, still had 25% of these goods within its inventory at the date we report. So the remaining stock is there for 25% of this 200. But is this what we are looking for? No. What we are looking for is how much profit remained in this remainder. You know, this is the remaining stock. What we are looking for is how much profit remained in it. What are we told is the profit fraction that 20 reported on their sale. 20 reported how much profit on sale. Let's go back to note number 4. On sale, we are told that 20 Limited reported profits of what percent? Note number 4. Look at the second statement. The second statement, note number 4. We are told that 20 Limited reports a gross profit what? Mark up. Be careful on this, by the way. Reported a gross profit mark up of 25%. So let's agree. 25% is the profit reported. But this 25% we are told is a markup. And this is normally a catching point. This will catch you if you're not careful. Whenever you are told you have a profit markup, you can't use it on a selling price to get profit. The markup is normally a profit on what? Markup is normally profit on cost. Remember, the 200 million is not cost. The 200 million is the sales value. So this is therefore the selling price. So you cannot use a markup on selling price to compute profits. Note what you are taught in your introduction to FA, that markup is the profit on cost, the profit on the selling price, which is now what we want. The profit on the selling price is what we call a profit what? A profit margin. That means that if 200 million is selling price and we want to compute the profit in it, you cannot work with the profit markup because markup is for the cost. What is for the selling price is a margin. So we must find the margin percentage. And when we have markup, how do we get the margin percentage? You are taught something in your introduction to FA, that if markup is A over B, if markup is A over B, then margin become A over what? A over B plus A. That is what you are taught. And so, our markup, which is 25%, is 25 over 100. If that is the case, then our margin will be 25 over what? Somebody. Our margin will be 25 over somebody over 120, 125. And so, as you then compute this UPS, as you then compute UPS, work with 25 over 125. How much UPS do we get? How much unrealized profits do we get? The UPS is how much? Somebody? How much is the UPS? Somebody? The UPS is 40. Stella says it is 10. So which is which? Somebody said 40, somebody 10. How much is it? Let me have a confirmation. Is it 10 or 40? Yes. Again, 40, 10, which is which? 10 million. So that the fifth confirmation is that this is 10 million. So that is how you will compute UPS. But then let's agree that just computing 10 million, that's not beneficial. The question is, how do we account for it? You know, this is what we have said, that the UPS is in what? The UPS is in closing stock. So within closing stock, we have the UPS of how much? 10. But this 10 we have said is UPS because it is fake. If this is fake, and we have included it within closing stock, then it's more or less like we have overstated closing stock. So the first treatment for this 10 million is that because we have overstated closing stock, we are going to minus this thing. We are going to minus from closing stock, and what? We minus from closing stock and what? We minus from closing stock and from profits. You know, you have to remember that when the selling company 20 initially recorded the whole 200 is a sale, the 200 had all the profits on the sale, including this UPS. So when 20 computed their final profit must be containing even this fake profit of how much? 10 million. Because that is the case, then even profit was overstated by how much? By 10. If that's the position, then you need to minus from profit also. So the adjustment which you need to note is that you minus UPS, and this will never change from one question to another. Yeah, always minus UPS from two things: closing stock, and then from the resultant profits. And that's the treatment for the UPS. All right. That is it for note number 4. Let's go to note number 5 and look at what we are told in note number 5. Note number 5 that will now give us working number 4. What are we told in note number 5? In note number 5, we are told that Trader Limited records showed a receivable due from Kuja Limited of 140 million shillings, which corresponded with the balance in Kuja Limited's payables. What is this thing? When Trader Limited has an amount due from Kuja Limited, you know, we are told that Trader Limited is reporting a receivable. So in their receivable, they have that 140. Because it is owed by company Kuja. Kuja, on the other hand, in their payables, they have reported that we owe 20, the same 140. What is this thing? When group companies owe each other money, this kind of a balance is called intragroup. This kind of a balance is called intragroup indebtedness. This kind of a balance is called intragroup indebtedness, or alternatively, what we can call an intragroup balance. So this is very simply an owing by one group company to another. Like now, in this case, the intragroup owing, we are told that we have how much? 140 million. If one is owing the other, the one owed reports a receivable, whereas the other one owing reports a what? A payable. Within therefore receivables and payables of these two companies, we have this 140. But again, upon consolidation, remember, the two companies become one. If you are one person, you cannot say that you owe yourself. This owing that they therefore report, is also therefore considered what? Fake. If the owing is fake, but then it's been included in receivables and payables, yeah, then upon consolidation, we must eliminate it. How do we eliminate it? We are going to minus once again. We are going to minus this thing. We are going to minus from what? The group, from the group, receivables, and also minus from the group payables. And that's how we shall treat that thing. Later, as we prepare the balance sheet, we shall from receivables minus 140. Again, we shall from payables minus also 140. And very simply, that's how we account for this thing. Let me ask whether so far there is any question on this. Is there any question on what we have explained so far? All right. If there is no question, then let's proceed to note number 6. Thank you very much, Pius. You comment that the flow is wonderful so far. You said the flow is wonderful so far. So that means there are no questions. Let's proceed to note number 6. In note number 6, we are told that an impairment review concluded on the date we report on 31st March 2022 revealed that goodwill arising on the acquisition of Twende Limited was impaired by 10%. No impairment loss has been reported in prior or previous years. Allow me to say this. Upon the parent company acquired, upon Kuja Limited acquiring company 12, we must check whether on the acquisition there arose some goodwill. If you guys remember, under converting a partnership into a limited company, when we prepared for the new company, the account we had called the business purchase account, where we recorded assets on the credit of the account, liabilities and purchase consideration on the debit. The balancing figure, we found out it is a goodwill. The same thing happens here. When the parent company, Kuja Limited, acquire company 20, the acquisition can happen at a goodwill. Because goodwill is normally an asset that we capitalize, then we must find out how much is it. This goodwill that arose on the date we acquired the investee, first of all, how much is it? Once we know how much the goodwill is, then we shall come back to these issues of impairment of the goodwill that the question talks about in number 6. All right. How do we then compute goodwill on the acquisition of an investee company? Now let's go to the next working, where we then compute this goodwill. And I will determine it here. All right. We are going to say that we have working number 5, in which I will compute goodwill and the impairment on it. But of course, for the impairment, that's simple to determine. What is tasking determining is this, which we call what? We call goodwill. Now allow me to say this. There are 2 methods which we can use to compute this goodwill. And by the way, the notes are very clear on this, so later you can read in detail what the notes are saying about this. There are two methods we can use to compute goodwill. The two methods include which ones? One is what we call the partial method. And then number two is what we call the full method. Those are the two methods that we can use to compute goodwill. Which are these two approaches? Under the partial method, the only goodwill we consider is parent's goodwill. So that under the partial approach, the only goodwill we determine is for the parent company only. Like here, parent is company, Kuja. Under the partial approach, we shall determine goodwill for Kuja only. Now, what about under the full approach? Under the full approach, we do consider the parent's goodwill, but then additional to it, we consider goodwill for the NCI. And that has to be very clear. What then differentiates between the two methods is the goodwill for NCI. Under the partial method, the goodwill for NCI is not considered. But then under the full method, we do consider goodwill of parent as well as goodwill for the non-controlling interest. Now, which method to work with depends on the provisions in a question. Some questions will directly say that use the partial or the full goodwill. In such a case, fine, it is direct. Some questions, however, will suggest which method to use. And what will suggest which one to use is a note we skipped. And so that, go back to note number 2. Go back to note number 2. In note number 2, we are told that it is the group's policy to measure the non-controlling interest at what? At fair value at the date of the acquisition. What follows is what I want. That the fair value of the non-controlling interest in 20 Limited on the date we acquired 20 amounted to how much money? 1370 million. Let me be very clear and please take keen note of this. When a question gives the fair value for NCI, like now this question gives the method to use will be method number 2. That's the full method. Why am I saying so? Because for you to compute the NCI's goodwill, you will need that fair value for the NCI. So the moment in any question you have been given the fair value for NCI, then let's appreciate you must compute the full goodwill. That means compute goodwill for the parent separately, again compute goodwill for the NCI also separately. So that, ladies and gentlemen, we shall then work with the full approach and calculate the two goodwills. Let me start with the parent's goodwill. Now, let me say here, we have shillings. For us to compute the parent's goodwill, we shall start with the purchase consideration. So how much purchase consideration did the parent company pay to acquire the subsidiary? Like in this case, what price are we told that Kuja Limited paid to acquire the 70% of the shares in 20? Go back to the second paragraph. Uko mwanzo, the second paragraph. And in the second paragraph, look at what we are told. That the acquisition consideration, the same as the purchase consideration, consisted of cash amounting to how much money? 3.6 million. So the purchase consideration that Kuja paid to acquire 20, this amounts to 3.6. So you start with the purchase consideration. Now, from the purchase consideration, you proceed to less. You proceed to minus what I'll call the net assets acquired. The net assets acquired in who? In 20. In 20. In other words, when Kuja Limited acquired company 20, how much net assets did it acquire? Did it acquire, remember, in company who? Company 20. How do we get the net assets acquired? The net assets acquired will be computed as what? The parent company acquired 70%, remember, of company 20. The 70% we multiply by what? The total net assets of 20 on acquisition. That's how you compute the net assets acquired by the parent. The percentage that the parent bought. The parent bought 70% in this case, times what net assets in total did 20 Limited have on the date the parent acquired it. So look here. If we have the total net assets directly, this should be very simple to get. But unfortunately, this is made difficult to compute, so that you are not given the net assets figure, you then must look for it. How do you get this thing? Because almost all questions will not give it to you. So in almost all questions, you have to compute it. Now, let me remind us. Let me remind us that when I talk of net assets, what do I mean? A net asset is normally total assets minus total liabilities. That is what net assets is. Assets minus liabilities. All right. In your introduction to financial accounting, you must have been taught about the accounting. You must have been taught about the accounting equation. And you are taught that the accounting equation is asset is equal to what? Capital plus liabilities. But at this level, we don't talk about capital. Capital is part of what we call equity. So assets should equal equity plus liabilities. Related to the net assets equation, related to this, we can have assets minus liabilities. Remember, in this equation. So that in this accounting equation, assets minus liabilities is equal to what? Equity. Allow me to say this. When I talk of net assets, therefore, When I talk of net assets, therefore, net assets is normally equal to what? The sum of equity, the sum of equity items. So that, like, now in this case, the total summation of the items of equity of company 20 on the date we acquired 20, that summation is what we call the net assets what? Figure. I want you guys to do this. Go back to the balance sheet. Identify which items of equity we have by company 20. What items of equity do we have in the balance sheet? Go back to the balance sheet. And very quickly, the items of equity in the balance sheet include which ones? The first one we are told is the ordinary share capital. We are looking for net assets by company 20. I will repeat, by 20. By 20, secondly, on the date we acquired it. So the ordinary share capital by 20. Look at 20's balance sheet, the second balance sheet. How much ordinary share capital do we have? 3,000. 3,000. This is followed by, which is the next equity. The next item of equity, we have share premium. But under 20, we don't have it. It's a nil. So forget about the share premium. Go to the next one, revaluation surplus. So that next, we are going to say that the next item of equity, we then have revaluation what? Now surplus. But then be careful. Be careful. You know, something like revaluation surplus changes. Because this balance sheet is to date, you must ask yourself whether is that amount for the revaluation surplus what we had on the acquisition date of company 20. Is that what existed on the acquisition what? Date. And in the context of this question, that's a no. What you have in that balance sheet, and that's how much? 700. That's not what we had on the acquisition what? Date. How much revaluation surplus did we have on the date we acquired company 20? Let me remind you. Come back to this working number 2. Come back to this working number 2. The only revaluation surplus by 20, remember on acquisition amounted to this 100 million. So out of the total of how much? Out of the total of 700 in the balance sheet, out of the total of 700 in the balance sheet, only 100 existed on the acquisition as per this working number what? Number 2. So the only amount that we'll consider here is therefore 100 million. That has to be very clear. Let's go to the next. After revaluation surplus, the next equity we are told is the retained what? The retained earnings. The next equity we are told is the retained earnings. Now, the retained earnings, again on it, you have to be careful. You are going to ask yourself, the 2530 that we have in that balance sheet, is that what we had on acquisition of 20 really? Anything you include here must be the value on the acquisition date. It must be on the acquisition date. So the 2530, which is in that balance sheet, is that what we had on the acquisition date really? For the retained earnings, never, that's never the profits that you had on the acquisition what date. Because in this question, the subsidiary was bought many years back. Fortunately, the question will tell you exactly how much you had on the acquisition date. Let me draw your attention to the second paragraph under the introduction. Go back all the way to the introduction, the second paragraph. After the second paragraph contained two things. One was the purchase consideration. The second one was the retained earnings that 20 Limited had on the date we acquired it. So the second part of that introduction tells you that 20 had what retained earnings on the date we bought it. 870. 870. When you look at the balance sheet, we don't have another item of equity. If we don't have another item of equity, then we can compute the total net assets figure. So that on the date we acquired 20, the net assets in total that ilikuwa nayo is there for 39 what? 3970. Is this what we are looking for? This is not what we are looking for. What we are looking for that is what we want to less is the net assets that the parent acquired. If on the date we acquired 20, the total net assets in it was 3970, how much did the parent acquire? Look here, the parent acquired 70% of this total figure. I'll conclude here and say that therefore, they acquire. What we are looking for is they acquired. Therefore, they acquired is 70% multiplied by 3970. The parent, therefore, acquired how much? Somebody. The parent, therefore, acquired how much? Somebody? The parent, therefore, acquired how much? Somebody?
27.79.
70% of the 970. That's how much? 20?
27.79.
2779. 2779. So that's what the parent company bought. If that's what the parent bought, then we can now compute, we can now get our goodwill. Our goodwill, and this goodwill is whose? Is parents. So that if you now minus the 2779, if you minus 2779 from 3600, the goodwill that the parent acquired, we have 821. Somebody says so. So we have 821. 821. So that is the parent's what? Goodwill. Now allow me to very briefly remind you that if the question had said, or if the question had recommended that we work with a partial method of computing goodwill, then it is this goodwill of parent only. Under the partial approach, we consider the goodwill of the parent alone. So under the partial approach, we would leave the goodwill at this. But then I've said, for the reason which we mentioned earlier, in this question, the method we use is the following. So that in addition to the parent's goodwill, we compute the goodwill for NCI also. So at this point, we shall need the second goodwill. And whose goodwill is this? NCI's. NCIs. Now, how do we get the goodwill for NCI? Please listen. To get the goodwill of NCI is very simple. Look for the fair value of NCI. And this one, the question gives. What was the fair value for the NCI? Go back to note number 2. The fair value for the NCI, we were told, is how much? The fair value for the NCI in note number 2, we were told is 1370. So you look for the fair value for NCI. That is why note 2 gave you that fair value thing. So how do we get the goodwill for NCI from this? From this fair value for NCI, we minus, look here, we minus this. On the date we acquired the subsidiary, the total net assets in it was 3970. Okay? In computing goodwill for the parent, we have said out of 3970, the parent acquired 70%. What does that mean? The remaining 30% of 3970 is for the NCI. So to get goodwill for the NCI, it is this fair value 1370. You minus the proportion for NCI in this net asset figure. The proportion is 30% because parent bought 70. The remaining proportion for NCI is 30% of the 3970. And how much does that give you? Get that goodwill for NCI. So to get goodwill for NCI, you take fair value for NCI, you minus proportion for NCI within the net asset for the subsidiary on the date we acquired the subsidiary. And that's it. How much NCI's goodwill do you get? So get that bracket, minus from 1370, how much do we get? $179. So somebody says that we get 170, 179. Could somebody confirm that truly we get 179? Let me have a confirmation.
Yes, it's 179.
All right. If it is 179, then that's it. We add them. So if the two goodwills are added up, then we get the full goodwill. And the full goodwill, how much do you get here? How much is the full goodwill? Somebody? Yes, somebody? 1,000. So the full goodwill we have 1,000. So ladies and gentlemen, you have to remember that a goodwill is normally an asset. And so this goodwill of 1,000 shillings, we shall recognize as a non-current asset. We shall capitalize. So we shall recognize as a non-current asset. Now, whenever you have any asset, you have to remember, you must test it for a possible decrease in value. Just like for items of PPA, we test them for depreciation. Then even an asset like goodwill, you must test for decrease in value. When goodwill loses value, IAS 36, that's another accounting standard which you will do in advanced financial reporting. But this very thing you must know, that when goodwill loses value, that decrease in value is what in note number 6, the question calls what? Impairment. Is what in note number 6, the question calls impairment. Now, note number 6 says what? That the goodwill in 20 was impaired by what percent? 10%. We need to compute impairment. Then at 10%, 10% of 1,000 is 100. 10% of 1,000 is 100. Now look here. This goodwill of 1,000 on which we have computed impairment is goodwill for 2 people. This is goodwill for parent. Again, this is goodwill for NCI. When I calculate impairment of 100 million, it means that the impairment is also for 2 people. There is that proportion for the parent. There is also that proportion for the NCI. So we must separate this impairment into how much is parents, and again, how much is NCI. Because as we prepare the financial statements later, the 2 proportions are accounted for now differently. Please note, the parents' share is 70%. The share for NCI, we know, is the remaining 30%. So we calculate 70, 30% in this 100 for the two shareholders. Parent gets out of 100, the parent gets 70, the NCI then gets the remaining what? 30. And so later, as we prepare the financial reports, we will see how the 2 different impairments are then accounted for. Is there any question to that point? No question to that point? Please note, we have not yet started what the question requires. This is not what is required. These are workings. Requirement is different. By the way, we are not even through with the workings which we did. But I will stop there because of time. I will stop there because of time. I am going very fast, so allow me to stop there. Ladies and gentlemen, we'll meet on Thursday when we'll continue from here to completion for the question. So any question that you'll have, please ask it in the WhatsApp group. I'll answer it from there. Otherwise, thank you very much. Good night. God bless. And see you guys on Thursday. Asanteni sana, yeah?